in connection with prediction of market trends. The most important and the most popular theory is Dow theory. The Dow theory is a trading approach developed by Charles H. Dow, who is also known as the father of technical analysis. Dow was the creator of the first ever market index, the Dow Jones Industrial Average (DJIA). It was created with the intent of measuring the movement of the US stocks. Dow fleshed out the theory in a series of editorials in the Wall Street Journal, which was co-founded by him. The basic idea of Dow theory is that market price reflects all available information. The theory defines the rhythm of the market. He who has the eye to see it and the mind to understand can also learn to play it successfully. Dow believed that the stock market as a whole was a reliable measure of overall business conditions within the economy, and that by analyzing the overall market, one could accurately measure those conditions and identify the direction of major market trends and the likely direction of individual stocks. Now, there are basic tenets of Dow theory. We will see one by one. The first one, uh, the first aspect of Dow theory is that market moves in summation of three trends. The first trend, as per Dow theory, is the primary trend. Primary trend is the broad upward or downward movement in the price, known as the bull or the bear market, lasting for several years. The primary trend represents the overall broad and long-term movement in the market. In case of an uptrend, it is called primary bull trend. And in the case of a downtrend, it is called the primary bear trend. The primary trend is the most refined in terms of stages and can be observed not just in charts but also in the state of economy and business cycles. There are three phases of primary bull trend and bear trend. In a primary bull trend, the three stages are revival of confidence, number one. In the revival of confidence stage, people regains their confidence in the market and start their actions buying and trading in the market, buying and selling in the market. The second phase is the response stage of primary bull trend. It shows increased corporate earning and improved economic conditions. And the third phase of primary bull trend is overconfidence. It is on the belief that the market will never turn down, leading to rampant speculation and price rises based on hopes and speculations, ending with bursting of bubbles or sharp reversals or gradual topping out of the market. The three defined stages of primary bear trend are abandonment of hope, Post the failure of prices to rise higher and forming a deciding top on charts, the participants finally stop forcing money into the market and give up on speculation. This eliminates the weakest participants who entered the market at the price tops. The second stage of primary bear trend is selling on decreased earnings. As the results of companies churn out lower and lower earnings, selling and unloading of stocks push the prices lower. And the third phase of primary bear trend is the panic phase. It is the distressed selling of those who believe that the worst is yet to come, and it is an attempt to dispose their holdings before any adverse situations. Then the second trend as per the Dow theory is the secondary or the intermediate trend. The secondary trend is considered to be the most deceptive of the trends. The intermediate trend is of time duration shorter than the primary trend and unfolds as the reactionary movements within the primary trend. They have a span of minimum 3 weeks and up to several months. This trend is like a rest for the primary trend. It has a similar effect that of the primary trend. And the third trend as per Charles Dow is the minor trend. This is the daily fluctuations and is considered insignificant in Dow theory. This is because the minor trend is subject to manipulation and disruption by market noise. It is nothing more than day-to-day price movements. Another important tenet or the assumption of Dow theory is that the volume of trade in the market must confirm the trends. Dow was of the belief that trends in prices could be confirmed by volumes. When the movements in price were accompanied by high volumes, they would depict the true movement of the prices. According to him, volume should increase if the price is moving in the direction of the primary trend and decrease if it is moving against it. Low volume signals a weakness in the trend. For example, in a bull market, the volume should increase as the price is rising and fall during secondary declines. If in this case, if the volume bumps up during a decline, it could be a sign that the trend is reversing as more market participation turn bearish. Another assumption of Dow theory is that trends continue unless definitive reversals come about. Irrespective of the daily erratic movement and market noise that may be witnessed in prices, Dow believed that prices moved in trends. Reversals in trend are hard to predict unless it is too late due to the nature and difference in magnitude of trends. However, a trend is believed to be in action unless definitive proofs of reversals emerge.